When a portfolio takes a hit, investors routinely offset their capital gains by selling depreciated assets. This strategy captures a tax deduction from the wreckage to reduce their overall tax liability. But this raises an obvious mathematical loophole. What happens if an investor sells a losing stock strictly to trigger that deduction, but instantly buys the exact same stock back to keep their portfolio completely unchanged? This scenario collides with the doctrine of economic substance. This is a foundational legal principle dictating that to claim a tax benefit, a taxpayer must experience a genuine, meaningful change in their financial risk or position. An instantaneous buyback violates this doctrine. Because the investor immediately replaced the asset, their actual market exposure never shifted. Without structural rules to enforce this doctrine, financial markets would be flooded with artificial paper losses at year-end, executed entirely to evade taxation. To combat these artificial losses, the IRS relies on a strict statutory baseline, Internal Revenue Code Section 1091, universally known as the wash sale rule. The application of this code to individual investors is detailed in IRS Publication 550, which governs investment income and expenses. The core function of Section 1091 is absolute. It automatically disallows a capital loss deduction if the IRS determines the taxpayer has not meaningfully altered their market exposure. To understand how this works, we will map the statutory time limits, deconstruct the math of deferred losses, and examine how institutional managers legally navigate these constraints. The wash sale rule acts as a structural boundary, dictating the execution of every professional portfolio management strategy. The IRS uses a rigid chronological boundary to define an artificial transaction, the 61-day window. The timeline centers on the date an asset is sold at a loss, day 0, bracketing 30 days prior and 30 days after. Purchasing a substantially identical security, contract, or option within this 61-day window triggers a wash sale violation. In practice, substantially identical covers a wide net. It includes different share classes of the same company, such as American Depository Receipts, or ADRs. ADRs are certificates issued by a U.S. bank representing shares in a foreign stock. It also includes options contracts, preventing investors from using derivatives to synthesize the exact same position they just sold. Furthermore, the IRS tracks this exposure across all of a taxpayer's related accounts, including spousal accounts and corporate entities they control. Relying on strict chronology and broad asset definitions, regulators prevent mathematical loopholes that allow an investor to maintain identical economic risk while claiming a loss. There is a common professional misconception regarding Section 1091. A wash sale does not destroy a tax deduction, it merely defers it. This T account tracks a disallowed loss. Buying 100 shares for $1,000 and selling at $750 realizes a $250 loss. Repurchasing them for $800 triggers a wash sale. The $250 loss moves directly from the P&L into the new purchase price, creating a $1,050 adjusted basis. The holding period of the original asset also transfers to the new replacement shares, maintaining the investor's timeline for long-term capital gains rates. The tax code holds the loss's financial value in escrow within the new asset's basis, preserving it until a genuine final disposition occurs. There is one dangerous exception to the basis adjustment deferral rule: individual retirement accounts. Consider an investor selling a stock for a loss in a standard taxable account, but immediately buying replacement shares inside their tax-advantaged IRA. This graph shows how a specific cross-account transaction breaks the standard tax accounting math. Instead of transferring, the $250 loss is permanently dissolved. The legal reasoning is straightforward. The IRS prohibits adjusting the cost basis of a tax-advantaged retirement account using a loss generated in a taxable account. This is the only Section 1091 scenario where a capital loss deduction is permanently forfeited, making strict account segregation a critical risk management priority. Complete liquidations often trigger false alarms, occurring when a brokerage custodian reports a wash sale that ultimately has no impact on year-end taxes. This inconsequential wash sale occurs when multiple lots of the same stock are bought and sold within the 61-day window, but the position is eventually liquidated. We chart the sequence of an inconsequential wash sale. We purchase one lot in February, another in March, and sell all shares simultaneously on March 10th. Because no replacement shares are held after the final sale, intermediate basis adjustments instantly net each other out. The wash sale rule only restricts losses when a replacement position is actively held open. A total portfolio liquidation restores the full tax deduction immediately. Moving past retail accounting mechanics, we enter the high-stakes execution of institutional portfolio management. Hedge funds face a central dilemma. How do they harvest massive tax losses at year-end without abandoning their required market exposure or triggering a Section 1091 violation? The first institutional approach is the proxy trade. The mechanics involve selling a specific depreciated equity to harvest the loss and immediately redirecting that capital into a highly correlated exchange-traded fund, or ETF, tracking the exact same sector. An ETF is a pooled investment security that holds multiple underlying assets and trades on an exchange like a regular stock. The legal justification relies on asset definition. Because an ETF contains a basket of stocks, it is not substantially identical to the single equity, allowing the loss to be realized while broad sector exposure is maintained. The second institutional strategy is doubling up. A fund buys a second lot of the depreciated stock, holds both lots simultaneously for 31 days to clear the statutory window, and then sells the original lot. These institutional strategies require accepting friction costs. Managers must accept either index tracking error with ETFs or doubled risk exposure for 31 days to successfully bypass the wash sale rule. Qualified funds have access to an institutional alternative that allows them to opt out of the realization framework entirely, the IRC Section 475 mark-to-market election. This election allows professional traders to treat their entire portfolio as if every asset were sold at fair market value on the final day of the tax year. This dashboard illustrates how the mechanism interacts with the wash sale rule. Because the assets are marked to market, unrealized losses are instantly converted into realized ordinary losses, entirely bypassing the 61-day windows. However, this move requires a severe trade-off. While Section 475 streamlines reporting and immunizes the fund against wash sales, it forces all gains to be taxed at higher ordinary income rates, rather than preferential long-term capital gains rates. We now pivot to the modern unregulated frontier of wash sale mechanics, cryptocurrency. Under current law, cryptocurrencies are generally not classified as securities under Section 1091. This creates a temporary regime where wash sale rules do not apply to digital asset swaps. While the rules for digital assets and ETFs are constantly evolving, the underlying doctrine of economic substance remains the primary regulatory requirement for tax law. It forces a perpetual arms race between IRS regulators and institutional traders, defining the boundaries of market exposure and legal tax reduction.